A very good morning, friends. So I hope you're all doing good, and I hope your revision is also going good. We started our journey on the revision of consolidation standards with you, and we've covered a couple of questions on Index 103 so far. If you recall, our main focus in terms of Index 103 has been on the calculation of the purchase consideration, as well as different aspects of purchase consideration, where we saw the concept of in detail how does the contingent consideration is accounted, how is the PHI, the previously held interest, also accounted. We made some couple of mind maps on that as well. And we also did one complete question on the concept of acquisition accounting. And now we're going to go further because, as you know, in terms of Index 103, there are a total of three, you can say, accounting treatments available. One is, we can say, acquisition accounting, and one is what we call reverse acquisition, and the other one is what we call common control transactions. Okay, I think now my electricity is back. I think you could not see my video was getting a little black, I guess. I hope the visibility is fine now. Acha, okay. Can I just change the room in 2 minutes? Yeah. Just give me 2 minutes. I just changed my room. So I guess, friends, what we have covered so far in the previous session, we have done the aspect of one complete question on acquisition accounting. And today what we're going to do, as you know, that there are a total of three kinds of accounting, which is addressed by Ind AS 103. One is acquisition accounting, one is reverse acquisition, and the other one is what we call the common control transactions. So what we're going to do now, we're going to do a question on reverse acquisition with you, and then we're going to go to the common control transactions, and then we go on to the next standard as well, that is Ind AS 110. So let me, I think, come to a question, start with a little interesting question with you, and that is reverse acquisition. So question number 5, let's, I think, first read the requirement of the question. I always tell people it's important that you first read the requirement of the question and then you should look into the facts of the case. So it says calculate the fair value of the consideration. So it says calculate the fair value of the consideration transferred, measure the amount of goodwill, and prepare the consolidated balance sheet on September X1, and also required to calculate the earning per share as well. But I think the focus right now is not to calculate the EPS. The focus right now is in terms of making the consolidated balance sheet on 30th September X1. Now with this inputs, let's, I think, go back and let's now read the inputs which are given in the question. It says on 30th September X1, entity A issues 2.5 shares in exchange for each ordinary share of B. All the shareholders of B exchanged the shares in B. Therefore, entity A issues 150 ordinary shares in exchange for all the 60 shares of B. So very clearly we are given that the offer is made to all the shareholders of B. So A lands up issuing 150 ordinary shares for 60 shares of B, 60 into 2.5. Then he says the fair value of each ordinary share on 30th September for B is at the rate of 40, and the quoted market price of the A share is at the rate of 60. The fair value of A's assets and liability on 30th September X1 are the same as the carrying amount, except the fair value of non-current assets is 1500. So all the book values are equal to the fair values, but except for the non-current asset, which is got a fair value to the extent of 1500. Then further, we are also given the balance sheet of A and B immediately before the business combination. Now you can see the inputs with regard to the fact whether it's a reverse acquisition or not is clearly stated in the question. Because if you notice, we are given that entity A is the legal parent and is also called the accounting acquiree. B is the legal subsidiary, also called the accounting acquirer. I think this in itself is quite indicative that this is a case of reverse acquisition. Because when you say that the legal parent is supposed to be the accounting acquiree and the legal subsidiary is the accounting acquirer, I think it's absolutely straight that this is a case of reverse acquisition. But I think we are still going to prove that why is it a case of reverse acquisition. If you recall the calculations which we did in the previous class as well, we're still going to make evidence, a proof of the same as well. And then it says further in the additional information, the earnings of B for the annual period ending is 600 and the consolidated earnings is 800. That's all for the purpose of calculating the EPS. Now assume that there is no change in the number of ordinary shares issued by B during the annual period December X0, and it says during the period January to the date of reverse acquisition. I think that's all the information for the EPS. But as I said, my focus right now is making the consolidated balance sheet on the date of acquisition. So as usual, what we're going to do, we're going to apply the 7-step model. Though in this particular case, I think we'll not put the entry. So we'll effectively apply the 6-step model. And then we are going to make the consolidated balance sheet as well. So let me, I think, start the inputs and let me do this on the Excel sheet. Larger questions we're doing on the Excel sheet. So let's, I think, begin with the input. So this is question number 5. So I'm going to first of all start the input in terms of step number 1. As I said earlier as well, that one you want to make them as working notes, you can do that. Or in case you want to call them as step numbers, I think it works perfectly fine. So step number 1 would be getting the date of acquisition. I think let me put it complete. So we want the date of acquisition. And I think the date of acquisition is very clearly stated in the question, 30th September X1. So we just put this out, DOA, date of acquisition is supposed to be 30th September, and that is 2000 X1. The next agenda is the step number 2, which is the crucial step. This is identifying. This is identifying, you can say, the accounting acquirer. So we need to identify the accounting acquirer. So in step number 2, we need to identify the accounting acquirer. Now, in this particular case, when you need to identify the accounting acquirer, though it is very clearly stated in the question that accounting acquirer is supposed to be B Limited. But as I said earlier, we are still going to make a proof, and trust me, all the calculations we're going to make in step number 2 is definitely required when you're going to do the calculations of the purchase consideration as well. So I would say, even if it is explicitly given in the question that it is a case of reverse acquisition and you're clearly given that B is the accounting acquirer, I would still insist you should make your calculations still. So what are we going to do in this case? We've got company A and we've got company B. Now let's first of all pick up what is the number of shares which are there in each of these companies. Let's get back to the question. So we are given, if you look at the balance sheet of A and B, so we're given that A has got a total of 100 shares and B has got a total of 60 shares. So we fit in this. A has got a total of 100 shares and B has got a total of 60 shares. Now, A told the shareholders of B that I'll give you 2.5 shares for every 1 share held. So I think if I look at the ratio of exchange, the ratio of exchange in this particular case is given to me, that is to the extent of the ratio of exchange is supposed to be 2.5 is to 1. That means you are going to issue 2.5 shares for every 1 share held. So if you multiply 60 with 2.5, you'll end up issuing 150 shares. And this is already given in the question as well, that what is the number of shares to be issued. So the company is going to land up issuing a total of 150 shares, which means what? Once A Limited lands up issuing 150 shares to the shareholders of B, the total share capital of A is going to become 250. There are already 100 shares in the company A, and you land up issuing another 150 shares, which means in this particular case, the total capital, you can say the total number of shares post acquisition, the number of shares which is post acquisition, this is going to become 250. Now, the interesting part with which you're going to identify whether it's a reverse acquisition or not, see what is the percentage post acquisition. Now, the shareholders of A have got 100 shares out of total 250 shares in the company, which means if you calculate the percentage, 100 divided by 250, that works out at 40%. So if you calculate the post acquisition percentage, the post-acquisition percentage of A Limited is 40%. That's 100 by 250 shares, which means indirectly B Limited shareholders are going to get a 60% stake in the company. So at the end of the day, we can clearly see that the shareholders of A will lose the control over the company A. B, who is getting the consideration, rather I would say B, the shareholders of B, who are getting the consideration, will be getting 60% stake post business combination. So ultimately, in spite of the fact that they are getting shares, but they are, you can say, indirectly getting a control of the company. So A loses the control. So we can make a clear-cut inputs that who is the accounting acquirer in this case? Undoubtedly, the accounting acquirer is B Limited. Now, as I said earlier, the question is very clearly telling you that B is the accounting acquirer. But I think it is still important that you make all these calculations. Because trust me, these calculations are going to be important for the purpose of making the calculation of the purchase consideration. So it can be an interesting invitation by the examiner that he gives you the percentage. I mean, he tells you the accounting acquirer, but I would say you must still make these calculations because these calculations of 40 and 60% has got a very important role in terms of calculating the purchase consideration. So once you say that accounting acquirer is B, you can also give a conclusion to the examiner, though it is clearly stated that this is a case of reverse acquisition. Right, so I think this takes care of the agenda on step number 2. Then we come to the step number 3, which is the calculation of the purchase consideration. And that is one of the, rather, I think, first of all, let's do one thing. Let's get the net assets. Net assets of accounting acquirer. Now, interestingly, we are not given any taxation rate in the question. Now, if there is no taxation rate which is given in the question, can I say in this particular case, there is no deferred tax implication? Because I said that there is a step number 3A and there is a step number 3B. So if it is a case where you're given a tax rate in step number 3A, you need to organize the deferred tax. But I am not given any tax rate, so we directly go to the net assets of the accounting acquirer. Now, when you say that we need the net assets of the accounting acquirer, sorry, accounting acquiree, I'm afraid. So when you're looking at the accounting net assets of the accounting acquiree, A, who is the legal parent, is supposed to be accounting acquiring. And I would also like to pinpoint something interesting to you. If you just go back on the additional information and have a look at the very first paragraph, there was another subtle hint that this is a case of reverse acquisition. It says the fair value of A's assets and liabilities are same as the carrying amount, giving you the status that the fair value and the carrying amount of A is equal, and then giving you the fair value of non-current assets of A. That was also indirectly telling you that A is supposed to be the accounting acquiring. And I would say there is a third hint as well. If you notice the ratio of exchange, you are issuing 2.5 shares for very one share head. Now, if the company which is issuing shares is going to land up issuing so many shares to the other company, for every one share, you land up issuing 2.5 shares, you land up issuing too many shares to the other company. Naturally, there is a tendency, there is a possibility that the other company shareholders are going to get a control over your company. So I would say 3 inputs in the question, which is very clearly indicating that this is a reverse acquisition, a too much of an adverse exchange ratio, where we are saying that we're going to issue 2.5 shares for every one. Second, the status of the net assets of A being given, which is indirectly indicating that it's a reverse acquisition. And the third one is very direct because in the balance sheet itself, it is very clearly given that A is the accounting acquiring. Okay, so what we're going to do now, we're going to organize all the data. So we are going to pick up the assets and the liabilities one by one. So we can start with the asset side of the balance sheet. And I think except for the non-current assets, which has got a fair value of 1500, we pick things as it is. So current assets is to the extent of 500. So let's take the current assets. That is 500. Then there is non-current assets, that is 1500. I think that's it on the asset side. Then there's a current liability of 300. So we take the current liabilities, that is 300. I'll put it in the brackets. Then there is non-current liability, that is 400. I put this in the brackets. So I think the assets and liabilities are done. And I think that's it. There's no other assets and liabilities given. So this is going to give us the net assets at a fair value for the accounting inquiry. And that works out at 1300. Super. So step number 3 is done. Now comes the crucial step. And that is the step number 4, which is the calculation of the purchase consideration. Now, this is what we need to be very careful as we calculate the PC. So let's go to the step number 4. That is the calculation of the purchase consideration. Now, when you calculate the purchase consideration, immediately the thoughts which should come to the mind is that purchase consideration in terms of reverse acquisition involves a little special calculation. So in this particular case, we need to consider not what is given, but we need to consider what would have been given. Mind the words again. Because normally, when you calculate the purchase consideration, you consider that what is the number of shares which are issued. But when it becomes a case of reverse acquisition, you need to see what would have been issued. So let's, I think, first organize the data. So we can say number of shares. We can say the number of shares issued. Number of shares issued by A that we already know is supposed to be 150 shares. But I am not concerned with the number of shares issued by A. We are concerned with the fact that if B would have issued the shares in such a way that he would have maintained a control over the company. And that's where the calculations in the step number 2 is going to be important. So if you come back on the step number 2, we've already seen that post business combination, the percentage shareholders of B is 60%. So we need to calculate if B would have issued the shares in such a way that he would maintain a 60% stake, what would have been the number of shares which would have been issued. So what we're going to do, we're going to come back to the calculations. So we'll tell the examiner how many shares would have been issued. How many shares would have been issued by B Limited if it wants to maintain the same percentage, that is 60% post acquisition. So I think that 60% which you calculated in the step number 2 becomes pertinent, because now we need to understand how many shares would have been issued by B if it wanted to maintain the same percentage of 60%. So in this particular case, we can say, if you look at the number of shares in the company B, it is 60 shares. So let's assume B Limited would have issued, let's say, X number of shares. So let's consider that B Limited would have assumed X number of shares to the shareholders of A to maintain that 60% holding. So we can say the total shares of B Limited post-business combination would have been 60 plus X. So the shareholders of B have got 60 shares, and if they would have issued a total of X number of shares, the total share capital would have been 60 plus X, and they would have issued the shares in such a way that they are able to maintain a 60% holding in this case. So I think let me just put the questions again, the inputs again, because this is the most crucial aspect in terms of reverse acquisition. Because in terms of reverse acquisition, the PC is not the fair value of the shares which are actually issued. But the PC is supposed to be the number of shares which would have been issued if B Limited wanted to maintain a 60% stake. So considering that he would have issued X number of shares, so we know that he has got 60 shares and the total number of shares is 60 plus X, and he wanted to maintain a 60% stake. You solve the equation and we're going to get the value of X that is equal to 40 shares. So we can say we made the calculations that if B wanted to maintain a 60% stake post business combination, he would have landed up issuing a total of 40 shares to the shareholders of B. And with this now, we can calculate the purchase consideration. It is equal to 40 shares, which would have been issued to the shareholders of A. And we also need the fair value of the share. And I guess if I come back on the question, in the very first para, we are given the fair value of the shares of B is at the rate of 40 per share. So we can multiply this with 40 per share. B would have issued 40 shares at the rate of 40 rupees per share. The purchase consideration would have been 1600. That is the calculation of the PC. Now, there is another interesting input which you need to give it to the examiner. And if you look at the solution of this question also, it's there in the study material as well. It's there in the education material as well. And they've given one very important calculation, that if your purchase consideration is mainly in the form of shares, or I would say only, I would say only in the form of shares, then the purchase consideration is not based on what is issued. The purchase consideration is based on what is acquired. So the standard has also made it very clear that if your purchase consideration is only in the form of shares, PC is not the fair value of what is issued, but PC is the fair value of what is acquired. So right now 1600 is based on the fair value of what is issued, though it is of course supposed to be fair value of something which would have been issued. So we'll also give a note to the examiner and we'll tell him that yes, as per the standard, we know that if the purchase consideration is in the form of, if the purchase consideration is in the form of shares only, if it is in the form of shares only, PC is fair value of what is acquired. PC is the fair value of what is acquired. So I think in this particular case, what we try to understand is if B would have issued 40 shares to the shareholders of A, he would have got a control of all the 100 shares of A. I put this again. If B would have acquired, if B would have given 40 shares to the shareholders of A, he would have got a control over the 100 shares of A. So we can say by issuing, you can say 40 shares, by issuing 40 shares to the shareholders of A, by issuing 40 shares to the shareholders of A, B Limited will get control. B Limited will get control of 100 shares of A. So when you're going to calculate the purchase consideration, we need to tell the examiner that since the PC is only in the form of equity shares, we need to consider the PC in terms of what would have been acquired. So we can say the purchase consideration in this particular case is supposed to be, we get 100 shares, the control of 100 shares of A, and if you go and see what is the fair value of A, we're given the first para itself, the fair value of the share is supposed to be 16. And that again works out at 1600 itself. That again works out at 1600 itself. So your PC in this particular case remains the same. Now let's also try to understand that why did it exactly remain the same? You consider the fair value of what would have been issued and you calculate the fair value of what is acquired, you're getting the same results. The reason is simple, that if you calculate that the fair value of the share is 40 and the fair value of the other company is 16, and if you divide this, it comes to 2.5. The exchange ratio is been decided on the basis of fair value of the share. If the exchange ratio is decided on the basis of fair value of the share, naturally in this particular case, whether you consider the fair value of what would have been issued or you consider the fair value of what is acquired, you are going to get the same results itself. I hope, friends, I am pretty clear on this particular aspect. I think let me just still connect the dots once again and consolidate this point, because I think in the case of reverse acquisition, the only agenda, in case of reverse acquisition, I think the only agenda is supposed to be in this particular case. You can say the crucial point is in terms of calculation of the purchase consideration. So I think if I just connect the dots once again, if I just connect the dots once again, then let me just put the thoughts out here. So we can say that when you consider a case of reverse acquisition, you need to first of all identify not what is issued. Mind the words. You are not required to identify what is issued. You need to see what would have been issued. If B Limited wanted to maintain a percentage of 60% as per the step number 2 calculations, you need to first of all identify what would have been issued. And in this particular case, 40 shares would have been issued. And once you consider the purchase consideration, you can say 40 shares would have been issued by the shareholders of B at the rate of 40, and the purchase consideration is 1600. The other thing is the standard Ind AS 103 also tells you that purchase consideration, if it is paid only in shares, what is more relevant is PC is not the shares which would have been issued, but PC is the shares, the control you would have acquired. So if B would have landed up issuing 40 shares to the shareholders of A, he would have got the control of 100 shares of A. So 100 shares of A into the fair value of A, that also comes to 1600. And I also proved the point that why it is coming the same, because the ratio of exchange is 2.5, which is completely based on the fair value of the shares. I hope the dots are connected well. Okay, so this is the step number 4. Now we come to the step number 5, and which is the calculation of the NCI. Well, in this particular case, we do not have any NCI because all the shares have been acquired. So in this particular case, we do not have any NCI. So we can say it's not there. Then we go to the next step, and that is the step number 6, which is the calculation of the goodwill, which is pretty simple and straight, because calculation of the goodwill is going to involve simply the plus and the minus. So in this case, we're going to consider the purchase consideration. The purchase consideration is 1600, and we add the NCI, but there is no NCI, that's 0. And we compare this with the net assets on the date of acquisition, which you've already computed in step 3. I guess that was 1300. That was to the extent of 1300. And I think that's it. So this will give us the element of goodwill, which works out at 300. Wonderful. So I think this is done. And in terms of reverse acquisition, we don't land up passing any journal entry. In this particular case, we are now going to make the consolidated balance sheet as it is. I'm also going to make the consolidated balance sheet. Now, in terms of the consolidated balance sheet, there are certain crucial issues which we need to keep in mind. So I think let me first of all pinpoint what are the crucial issues in the preparation of consolidated balance sheet. The first thing is when you're going to present a consolidated balance sheet, in that particular case, what do you need to do? Number 1, in this particular case, you are going to consider the fair value of A and you're going to consider the book value of B, because the A is the accounting acquiree and you need to consider the fair value, and B is the accounting acquirer, so you need to consider the book value. So you'll take the fair values for A and the book values for B. That is focus 1. The second is when you're going to consider the equity share capital. In this particular case, the equity share capital will be taken for A Limited itself. He is the legal acquirer, and the number of shares to be reflected in the balance sheet is from the point of view of the parent. And from the legal perspective, the parent is supposed to be A limited. So the number of shares which will be reflected in the balance sheet is going to be a total of 250 shares. But of course, when you're going to consider the values will be of B limited. So let's do one thing. Let's also make the consolidate balance sheet as well. So step number 7, rather I would say step 6 out here is the consolidated balance sheet. So we're going to pick up the balance sheet of A at a fair value and the balance sheet of B at a book value. So let me do one thing first of all. I'm going to consider the balance sheet of A and the balance sheet of B, and we can get the sum total as well. So it's a good idea to make sub-columns as well. Let's make the structure. So we've got assets, non-current assets. So we can take the format from the balance sheet itself. We've got NCA and the current assets. So we've got the total assets. And I think least we forget there is a goodwill as well. So let's take the goodwill also. Then we take the equity and liabilities, in which we consider the equity, and the equity is going to comprise of the equity share capital as well as retained earnings. So we have on the liability side equity share capital and there is retained earnings. And apart from this, I think we've given the non-current liabilities and we're also given the current liabilities as well, and there is no NCI. So let me just highlight the main heads as well. So this is non-current liability and this is current liability. Okay, now let's pick up the information from the question. So in this particular case, I think let's begin with the NCA. So as far as the NCA is concerned, it is fair value that is supposed to be 1500. As far as the non-current assets of B is concerned, that's 3000. So that's it. We take the sum total of this. As far as goodwill is concerned, already computed at 300. The current assets is supposed to be 500 and 700. So that is 500 and that is 700. And we take the sum total of this and that works out at 1200. So I guess my asset side of the balance sheet is done. That works out at 6000. Now, as I said, the crucial points in terms of the liability side is identifying the number of shares. And when you show the number of shares is going to be the total of 250 shares. That is the shares which the company A is got. Because the liability in terms of making the consolidated balance sheet is of A limited. So when you're going to present the balance sheet, we're going to consider the number of shares, which is 150 shares issued plus existing 100 shares, that makes it 250. But when it comes to the calculation of the value, in terms of the value, we are going to consider this. Okay, I'm getting a question as well. So am I correct in saying that for 60% consideration also being paid, hence we are concerned with calculating a consideration for acquiring the remaining 40% control? No, I would not say that. Okay, let me do one thing. Let me just finish with the balance sheet. I'll give you a little more clarity of thoughts. I'll give you 4 permutations and combinations to give you more detailed working on that. I think once we just finish the balance sheet, I'll do that as well. Okay, as far as the share capital is concerned, we know the share capital of the company B is supposed to be 600. So we can take this as a total of 600 and the purchase consideration is, I think, 1600. So this works out at 2200. And then we can also consider the retained earnings. That's 1400 for B Limited. And then let's consider the non-current liabilities as well. So in terms of the non-current liabilities, it is appearing at 400 and 1100. So this is 400, this is 1100. So we take the sum total of this, that is 1500. Same goes for the current liabilities as well. That's 300 and 600. That is 300, that is 600, and we get the sum total, that's 900. So hopefully the balance sheet should agree, and that works out at 6,000. So this is the balance sheet of the company done. Okay, now I think let me answer your question in a little more detail. Though I think this might be getting a little more technical, but I think let's give you that conceptual clarity. My question is done, the balance sheet is tallied, but I think I just want to now make, 3-4 crucial points at this stage. Now please hear me very carefully. I am going to make a total of 4 combinations. The combination number 1, that it is not a reverse acquisition. The combination 2, it is a reverse acquisition. So mind you, what I'm doing, I'm considering that it is not a reverse acquisition. And the other one is I'm considering, yes, it is a reverse acquisition. I'm considering PC is not only in shares. PC is not only in equity shares. So PC is not only in equity shares, or the PC is in equity shares only. So these are the 4 permutation combinations which are coming to my mind. We'll go to work one by one on these agendas and we'll get clarity of thought. So what I'm doing, I'm considering a total of 4 permutation combinations. It'll be great if you can watch me on all those 4 permutation combinations as well. So I'm considering the first case, it is not a reverse acquisition, and the PC is not only in equity shares. The second is the PC is in equity shares only, and then the same situation if it is a case of reverse acquisition. Now, if the PC is not only in equity shares, can I say the PC will be fair value of shares issued by A? Vouch me, is my thought correct? If I am considering that the PC is not just in equity shares, do we consider fair value of the shares issued by A? Vouch me for this. What do you say? Is my thought correct? I think that is a crucial question. You said no. No. It is 100% correct. Purchase consideration is the fair value of what you issue. If it is not a reverse acquisition, we need to consider the fair value of what is issued. So in this particular case, we would have calculated that A landed up issuing, can I say 150 shares in his own company. And what is the fair value of each share? If I just go back out here, you can see the fair value of the shares of A is supposed to be at the rate of 16. So your purchase consideration in this particular case would have been 150 shares issued at the rate of 16, that works out at 2400. I hope the position is clear. So when it is not a reverse acquisition, mind the words, when it is not a reverse acquisition, we are saying, let's consider what is issued and let's consider the fair value of what is issued. Now, if you say the PC is in the form of equity shares only, now tell me one thing, if A issues 150 shares, can I say he gets a control over the entire business of B? He indirectly gets a control over the 60 shares of B. So we can say we need to consider fair value of what is acquired. What is acquired? And in this case, we can say by issuing 150 shares, you get a control over the 60 shares of B. Mind the words. By making a payment of 150 shares, you get a control over the 60 shares of B, and the share of B is 40, and that works out at 2400. The answers are coming the same only because the exchange ratio is based on a fair value. I hope I'm very clear on the first two cases. That if the PC is only in equity shares without a reverse acquisition, you are taking the fair value of what is given. Great. And if it is supposed to be equity shares, you need to consider the fair value of what is acquired. And now same calculations will go in terms of reverse acquisition as well. Now, if it is a reverse acquisition, we need to consider that PC is not in shares only. So we say, okay, what is the fair value of shares which would have been issued? Which would have been issued? So in this particular case, we are now calculating the fair value of the shares which would have been issued to maintain the percentage. We know that post business combination, B shareholders are getting a 60% stake in the company. So if they want a 60% stake in the company, they need to give 40 shares to the shareholders away. So how many shares would have been issued? And when I say would have been issued, we can say it is by B. To maintain, it is to maintain same percentage, and that is supposed to be, you can say 60%. So you need to see that, okay, if B would have issued shares to maintain a percentage of 60, how many shares he would have given? So we said he would have given 40 shares. And each share is worth 40 rupees each. So the purchase consideration would have been 1600. And now let's come to the other case. When you say the PC would have been in equity shares only. Now, if the PC would have been equity shares only, what do you need to see? The fair value of what would have been acquired. So we need to see the fair value of what would have been acquired. Very carefully using the language. You can see the language. It says on the first one, fair value of the shares issued. Then it says fair value of what is acquired. Then it says fair value of what would have been issued. And then we're considering the fair value that would have been acquired by B. So in this particular case, B, if he would have issued 40 shares, he would have got a control over the 100 shares of A. And if he would have got control of 100 shares of A at the rate of 16 per share, the purchase consideration would have been 1600. I think now you can compare all the permutations and combinations and you get the clarity of thought that PC is supposed to be what? So there are four cases. Trust me, there is no fifth case possible. If it is not a reverse acquisition, PC is not only in shares, then what? If it is in shares, then what? If it is a reverse acquisition, PC is not only in equity shares, then what? And if it is in equity shares, then what? I hope your question gets answered in detail on that, right? Okay, so far so good. I guess now I am ready to go to the next area of discussion. So I hope you got your answer on a very clear-cut inputs that you know what kind of permutations and combinations we are looking at. Because you know most of the times when we're calculating the purchase consideration is being computed on the basis of fair value of what is issued. But it is only in terms of reverse acquisition that we'll end up calculating that what would have been issued. And then if the PC is in shares, we need to identify, okay, what I would have acquired by giving the shares what I would have received. Okay, that's great. Now we are ready to go to the next area. So we've done questions on the case of acquisition accounting. We've done the case on a reverse acquisition. Now we're going to go on a question which is on common control transactions. Let's, I think, do a question on that area. So this question is done. Now let's have a look at the question number 6. So question number 6 is also there in the study material as well. And I distinctly remember that this question was there, in the old course actually. The interesting part is that this was there in the old course. I remember this question came in November 99, same name, same figures. And at that time, of course, India's was not there. But I just love this question because it's got absolutely same facts which was there in the old course paper. Let's, I think, look at the requirements of the question first. You are required to pass journal entries in relation to the above in the books of Maximini. Also, the balance sheet of the two company on the morning of 1st November X2 showing the corresponding previous year figures. The directors of the two company ask you to find out the net asset value of equity shares pre and post demerger. And then it says, comment upon the impact on the shareholders' wealth as well. Now let's look at the facts of the case and then we'll solve. It says Maxi Mini has got two divisions, Maxi and Mini. And the balance sheet of the company with a bifurcation of the assets and liabilities of the two divisions again. It is decided to form a new company, Mini, to take over the assets and liabilities of Mini division. Accordingly, Mini was incorporated to take over at the balance sheet figure the assets and liabilities of that division. Mini is going to get 5 crore equity shares of 10 each, is going to allot 5 crore shares of 10 each in the company to the members of Maximini in full settlement of the consideration. The members of Maximini are therefore to become the members of Mini as well without having to make any further investment. Now, before I solve this question, I think there is another crucial point which I would like to illustrate and elaborate at this stage. Technically speaking, how does one identify when you read a question at the very start that whether it is a case of acquisition or a reverse acquisition or is it a common control transaction? I think the litmus test is that you need to see is the transaction between a related party or is the transaction between unrelated party? So the moment the transaction is with a related party, the possibility is that it is a case of a common control. I'm not saying that it'll always be a common control. But the moment you see that it is a case of, a related party transactions, two companies related to each other, maybe the parent and the subsidiary are dealing with each other. So the moment you see that there is a relationship between the acquirer and the acquiree, it could be a possibility that it becomes a case of common control. But when the transactions are entered between unrelated parties, the possibility is that it'll become a case of acquisition accounting or a case of reverse acquisition. Now, when you identify acquisition or reverse acquisition, your step number 2 will give you the data. Because in step number 2, you will identify that is the company giving the shares, getting a control, or after giving the shares, he passes on the control to the other company. So that's the basic framework thought process you could apply, related party or not. Let's now come back on the agenda in this case. Now, in this particular case, if you technically see what is happening is a pure demerger. In this case, it's a case of a pure demerger itself. Because the company Maximini has got two divisions and you are dividing this company in terms of another company. One division of the company is being created as a separate company. And the shareholders of the new company, shareholders of the Maximini will also become the shareholders of Mini. Which means if the shareholders of both the companies are common, it becomes a common control transaction. Because the same shareholders have a control over Maximini, the same shareholders have got a control over Mini, therefore it becomes a common control. So I think let's do one thing now. We need to see the entries. So question number 6. So as per the requirement of the question, we are required to put journal entries in the books of the two company. And we're also required to make the balance sheets as well. So what I'm going to do in this particular case, I am going to make journal entries and then I'm also going to draft the balance sheet also. So let me just open the question in front of me As I saw, we'll need the figures as well. Okay, so I think let's start with the first requirement of the question. So I am given, first of all, the entries which are to be done in the books of Maximini and Mini. So I think let's begin with the books of Mini. Now, there are some few key points which I think we need to remember. So let's, I think, take a little quick recap on the concept of common control transactions as well. So we can just highlight that what are the key features in terms of common control transaction. Number one, when you consider a case of a common control, the entries are always recorded at a book value. The entry of acquisition, which is done in the books of Mini, is going to capture all the assets and liabilities in the book value. So is there a scope of recording any other asset and liability which is not in the balance sheet of the acquiree? What do you say? Am I only supposed to incorporate the assets and liability which are in the balance sheet of the acquiree? Can I incorporate any new asset or liability in the acquisition entry? And the big answer is no. You are going to record only the assets and liabilities which are there in the balance sheet of the acquiree, and that also at a book value. No new asset and liability can be captured, and there is no concept of fair value. Second, when you calculate the purchase consideration is going to consider the cash, and we are going to consider the shares, but not the fair value, the face value. So I think let me put some notes as a little mind map. So we can say the first thing is that we need to consider, we need to consider book value of all assets and liabilities. Because when it is a case of a common control, we are allowed what is called a pooling of interest method. And in terms of pooling of interest method, we follow book value approach. So no concept of fair value and no additional or liability. No additional asset or liability is captured. And number three, when you calculate a purchase consideration, it will be the cash plus the face value. I'm putting in the brackets, not fair value. We take the face value of equity shares issued. So I think these are three crucial points, which I think I've just put them as a small mind map, that when you're putting the entries in case of common control transactions, the concept is totally based on the book value, no fair value approach, and no other asset and liability other than what is appearing in the existing balance sheet can get incorporated. And the BC is based on face value. So I think let's go to the books of Mini, and we know that Mini is taking over the business of Mini division. So let's, I think, pick up the items of Mini. So I guess the PPE is to the extent of 200. The PPE gets a debit. That's to the extent of 200. The next item is the current assets. That's 300. So we go to current assets. That's 300. Then next we are given the current liabilities. That gets a credit. We're just picking up the items from the balance sheet of Mini, and that's to the extent of 100. And I think apart from this, we are also given a loan on the liabilities side. And the loan which is appearing to the extent of 100. So this takes care of all the assets and liability. Now, we're also going to consider the purchase consideration. And the purchase consideration is supposed to be the fair value of the shares allotted. So when you consider the fair value of the shares allotted, I am clear-cut given in the additional information that Mini is going to allot 5 crore shares of 10 each. I'm only concerned with the face value. So 5 crore shares of 10 each, the purchase consideration is going to be 50 crores. So I guess we're going to get a balancing figure in this entry. And I think the balancing figure works out at 250. Would you like to tell me where are you going to take this balancing figure? Are we going to record this in capital reserve? The difference which is arising is a capital reserve. And let's say, for example, if this difference would have appeared on the debit side, if the credit side was more than the debit side, are you going to call this as goodwill? The good question is, if you would have got the balancing figure out here, right now, yes, you're right, it is capital reserve. But in this case, if the difference would have appeared on the debit side, were you going to call this as a goodwill? No. Can I say in that particular case, it will be adjusted in equity itself. So common control transactions do not lead to any calculations of goodwill. It is going to be simply adjusted in equity. Then I think apart from this, we can also put the entry discharge of the PC. So the PC gets a debit, the equity share capital gets a credit, and the purchase consideration stands discharged. Well, so I think the entries in the books of Mini Limited is done. We're also now required to look into the entries in the books of Maxi Mini as well. So let's, I think, go to the next agenda. And then we're going to make the balance sheets as well. So let's now see the entries in the books of Maxi Mini. So let's see the entries in the books of Maxi Mini. I think if you look at the books of Maxi Mini, the objective is merely to close all the assets and liabilities which have been transferred to Mini. So basically, we're going to debit all the liabilities, we're going to credit all the assets, because the idea is only to close those assets and liability. So we're going to go to the balance sheet of Maxi Mini, and we're just going to pick up all the assets and liabilities and reverse them. Credit the assets, debit the liabilities. Let's begin. So in this particular case, I think let's look at the balance sheet of Mini. So accumulated depreciation gets a debit. All the credit balances are going to be debited and vice versa. So accumulated depreciation gets a debit, that's 100. The PPE gets a credit, and that's, I think, to the extent of 300. Next, I am given the current assets is 300 and the current liabilities is 100. So current liabilities gets a debit, and that's to the extent of 100. The current asset gets a credit, and I think that's to the extent of 300. So we're just closing all those assets and liability, and the loan also gets a debit, and that's to the extent of 100. That's it. The closure of all the assets and liabilities are done. Now, the only question which is now coming to the mind in this particular case is Maxi Mini going to reflect the receipt of the consideration? Of course not. Remember, the consideration is given to the members of Maxi Mini and not to Maxi Mini. So Maxi Mini will not be putting an entry where he says that investment in Mini gets a debit. Because when the company Mini Limited gives the shares to the shareholders of Mini, the company Maxi Mini in this particular case is not going to become the parent of the company Mini. So no reflections. So all you need to do is, if you look at the entry, there is a balancing figure that's going to be called as loss on reconstruction. And this loss on reconstruction is going to be adjusted in terms of equity. So when you're going to take the balance sheet, we will adjust this difference of 300 in the equity. You can say basically adjust it in terms of other equity, you can say. So this is as far as the accounting entry in the books of Maxi Mini is concerned. So what is to be done now? Once you've done the entries in the books of Mini as well as Maxi Mini, now we are going to make the balance sheets of the company with the comparative previous year figures as well. because he's also asking us to make the balance sheet of the companies as well. So let's do one thing. Let's now make the balance sheet of all these two companies. So what we're going to do, we're going to make the balance sheet of Maximini. We're going to make the balance sheet of Mini. When you make the balance sheet of Maximini, we'll make it pre-reconstruction. And we're going to make it post-reconstruction. And Mini is, of course, post-reconstruction. Because if you look at the requirement of the question very clear, it very clearly says the point number A, we need the balance sheet of both the companies showing the corresponding previous year figures as well. So we need to make a comparative financials as well. So let's do one thing. Let's copy the balance sheet of Maximini from the question. So I guess I'm going to read the non-current assets, PPE. And I guess there is current assets. That's it. So we get current assets. Then we take the equity and liabilities. Equity and liabilities. Then we consider equity. And within this equity, we're going to get equity share capital. So I think let me just take this little spacing, and this is post. So equity share capital. Then it is other equity. You can call it as retained earnings. Let's put it as RE. Then I think there is a loan, which is a non-current liability. So there is a non-current liability, which is loan, and there is a current liability. I think that's it. So we're just going to pick up the information, existing balance sheet from the question, then make some changes. So for the Maximini balance sheet, I just need to pick up the information from the question itself, just pick up the figures as it is. So I guess the PPE is appearing at 300 and the current assets is appearing at, I guess, 700. I think that's it on the asset side. So this makes it a total of 1000. The asset side is done. Let's also copy things on the liabilities side as well. So as far as the equity share capital is concerned, the equity share capital is appearing to the extent of, I guess, 50. Other equity is 650. So this is 50 and this is 650. The loan is 100. And I guess the current liabilities are appearing to the extent of 100. So I think this is, the balance sheet is done. Yes, it is tallied at 1000. So no, it's not. I missed it. 700. Oh, sorry, the current liabilities are 200. So current liabilities are to the extent of 200. So we've copied the existing balance sheet of Maximini as it is from the question. Now, the job is simple. If you want the balance sheet of Maximini, just incorporate the entry you did in the books of Maximini, closing those assets and liabilities. And if you want the balance sheet of Mini, just take the entry in the books of Mini. So I think the PPE, we made a reduction by 200. I guess we had transferred the assets worth 200 to the Mini division. So 100 goes here, 200 goes here. I guess if we look at the current assets, I guess current asset to the extent of 300 is gone. So leftover is 400. This is 300. So I think this is done. The asset side is done. So basically what we have done, we've just incorporated the entries we've done, then than in the two books of accounts. The equity share capital of this company continues to be 50, and he issued a purchase consideration 50, so that comes to 50. Now, in the books of Maximini, I think there was a loss on reconstruction. The loss on reconstruction was 300, so this comes to 350. And I think you got a capital reserve of 250, so that comes to 250. So in the entry, we had a 250 capital reserve, and he had a loss of 300 netted off. The loans is gone, and the loan has come here. I think the current liability 100 is left, and the remaining 100 is gone here. So I think with this, we are able to easily get the total of the balance sheet. So this is 500, and this is 500. The balance sheet is done. Wow. So common control becomes a very easy affair. So in this particular case, what do? We just land up putting entries, and then from the books of the existing company, you incorporate the closure of assets and liability. And for the company which is the resultant company, you just incorporate the assets and liability. The question is not done. We are now required to answer a few more requirements as well. The question says, apart from making the balance sheet of A and Maxi and Mini, now there are B and C requirements in the question. Directors are asking you to calculate the net asset value per share, pre and post demerger, and also explain the impact on the shareholders' wealth. So I think let's do one thing. The net asset value is nothing, but you can say it is supposed to be intrinsic value. So in this particular case, I think let's do the computation of net assets of both the companies. So we'll just make the calculations now. Computation of net assets value per share. So we've got Maxi Mini and we've got Mini. This is pre-demerger, this is post-demerger, and this is of course post-demerger. So we're just going to organize the net assets and calculate the intrinsic value per share. So let's see what is the net assets from the balance sheet. Divide this by number of shares. Divide this by the number of shares. We get the intrinsic value. You call it as intrinsic value, or you call it as the net asset value per share. One and the same thing. Okay, so I think let's go to the net assets. Let's go back to the balance sheet and see the net assets of the company. I guess if you want the net assets, one way is you take the assets minus liability, or the other way is that you consider the equity share capital plus the other equity. You get the same results either way. So either you take the assets minus liability, or you simply consider the share capital plus the retained earning. So I think this 50 plus 650, that makes it 700. And similarly, if you look at post demerger, I think it is coming to 50 and 350, and that's coming to 400. And similarly, this is coming to 300. So sum total of the equity share capital. So we just taken the sum total of equity share capital plus the retained earnings, or you can say the other equity. Now we need to divide this by the number of shares to get the intrinsic value. So this company had 5 crore shares, and this company was also created with 5 crore shares. We get the intrinsic value 140. We get the intrinsic value 80, and we get the intrinsic value 60. Wow. Now you can see something interesting to watch. If you take the sum total of the intrinsic value in terms of Maxi Mini post demerger and Mini post demerger, it is exactly equal to 140. And in this particular case, since the exchange ratio was 1:1, I think this is bound to be. So in this particular case now, he is also asking us what is the impact on the shareholders' wealth. He's also asking us what is the impact on the shareholders' wealth because of this intrinsic value as well. No. You can now consider very basic calculations, and we can say, in terms of the basic calculations, we can very clearly say that in this particular case, earlier, the shareholder had one share in Maximity, which was worth 140 each. So his wealth was 140. Now, if you consider he's got one share in Maximini, which is worth 80, and he's got another one share in Mini, which is worth 60. So can I say the total worth is still 140? Earlier, the shareholder had one share in Maximini, and now he's got one share in Maximini and one share in Mini. So if you combine the wealth of the shareholder, it still remains intact. So there is no change. There is no change in the wealth of the shareholders. There is no change in the wealth of the shareholders. Now, I have a few questions which is coming to my mind at this stage to get more clarity of thought that the question is done. Now, my question to you at this stage is, had the exchange ratio not been 1:1, maybe it was 2:1, or maybe it was 1:2, do you think the shareholders' impact on wealth would still be nil? Just imagine that the exchange ratio in this case would have been anything other than 1:1, because right now what you did, you give one share for against one share each. In this particular case, if you would have landed up issuing, let's say, a ratio change 1:2 or maybe 2:1, do you think the shareholders' impact on the wealth would have remained the same? What do you say? One can do the calculations as well and prove the point as well. And you said no, the impact would not remain the same. It would remain the same. I think let me do that. Let me, I think, just prove the point so that you can get the clarity of thoughts as well. I'm just going to do some calculations in red color so that you can see the contrast happening in this case. Now, let's imagine that you would have landed up issuing, let's say, one share for every two share. Let's say you landed up issuing one share for every two share. So can I say you would have issued 2.5 shares? The intrinsic value would have been 120, correct? I'm just, proving my point. The net assets would remain the same only in terms of value. But if you would have issued, let's say, to the extent of, the number of shares would have been 1:2. So you would have issued, let's say, 2.5 shares. So the intrinsic value would have been 120. Now let's go back. Can I say now, if you make your calculations at this stage, the shareholder has one share which is worth 80, and can I say he's got 0.5 shares at the rate of 120? Because he got only one share for every two shares. So basically, against two shares, he got one. Against one share, he got 0.5. So if you still add this up, it still works out at 140 itself. At the end of the day, trust me, whether the exchange ratio is 1:1 or it is anything other than 1:1, 2:1, 1:2, trust me, it would not make a difference at all. Because the thing is that in this particular case, when you are saying that it's a demerger and it is being accounted under a common control transaction, in that particular case, everything is getting recorded and captured at a book value. And if everything is getting captured at a book value, naturally, there will be no impact on the shareholders' wealth. You're basically splitting the companies into two different parts. That's it. So in any case, the shareholders' wealth impact in terms of, you can say, demergers would never occur. I hope I made my point clear on that. Okay, that was another interesting question. I think now I'll take you to another question as well. And this time it's going to be a blend in terms of, you can say, the common control as well as a reverse acquisition. There's another beautiful question. And this kind of question is come in the mock test papers. I remember it's in the examination question as well. It came for 16 marks in the exam. It's the examiner is asking you both the inputs in terms of common control as well as in terms of reverse acquisition. So I think after this question, we'll, I think, switch over to the concept of Ind AS 110. Though I put another one interesting question, but I think maybe we can do the question later so that we don't run short of time. But as I had promised, I am planning to take a very interesting question next class as well, typically on Ind AS 110, where I want to take a question which is going to contain a couple of adjustments, not added that in the assignment. I'll share that to you maybe in advance before the next session, and which contains all the adjustments, including the deferred tax implications as well. I think if you're able to do that kind of question, it's going to give you a wonderful insights. So at least the consolidation will be a very good revision, because in that case you'll be getting a flair of all the complicated adjustments as well. Let's begin with question 9 now. It says AX and BX amalgamated from 1st January X2, and a new company ABX with the shares of 10 each is formed to take over the business of existing company. Now I think immediately you would recall something interesting, that when you look at Ind AS 103, in terms of Ind AS 103, you would recall that there are basically two kinds of situations. One is that there is no new entity which is created, and one is that a new entity is created. So when you create a new entity, the accounting becomes slightly different, and when you do not create a new entity, the accounting is different. So in this particular case, you can see that the two companies are amalgamated and a new company ABX is created. Then the balance sheets of both the companies are given, and I'm also given the breakup of that other equity in the notes to accounts. And let's now have a look at the additional information. It says ABX issued requisite number of shares to discharge the claims of equity shareholders of the transferred company. Also, the new debentures were issued in exchange of the old series of both the company. Prepare a note showing the purchase consideration and the discharge thereof, and draft the balance sheet of ABX, assuming both the companies are under common control. And number 2, assume BX is a larger entity and their management will take the control of the entity ABX. He's indirectly already told you that who is the accounting acquirer. He's very clearly said that BX is the larger entity and he's going to get control over the entity ABX, which means that BX is supposed to be the accounting acquirer. But I'm going to still identify the accounting acquirer because, as I said, it plays a very important role in the calculation of the purchase consideration. The fair value of the net assets of AX and BX is also given. So I think let's begin the journey. I'm going to first of all start with a B point. Then I think we look at the common control later. So first, let's focus on the reverse acquisition, question number 9. So we are on question number 9. And I'm going to do the part number B first. And in terms of the part number B, it is very clearly given that it is a reverse acquisition, because the control is coming. The control in this particular case is coming, you can say, to BX, which is one of the existing company. So let's begin our inputs. We're going to apply these 6 steps again, get the date of acquisition. So if you go step by step, trust me, there's never a problem because the focus remains very clear as you proceed. So it's a good idea to go on a step-by-step basis. So let's see what is the date of acquisition. I guess on the date of acquisition, we are clearly given that it is 1st January X2. So date of acquisition is supposed to be 1st January X2. Then we come to the step number 2, which is identifying which is identifying, you can say, the accounting acquirer, which is identifying the accounting acquirer. So once we need to get the accounting acquirer, now very carefully, we'll first organize the number of shares. So let's see the number of shares which are there. So I think there are two existing companies which are given in the question. One is AX and one is BX. So I guess the company AX, each of them has got shares of 10 each. So that makes it 600 and 700 shares. So we've got company AX and we've got BX. So this has got number of shares 600 and this has got number of shares 700. Now, we are very clearly, first of all, given that BX is the larger entity, but I am still going to prove that. So now the question rises that once we are going to create this new company ABX, how many shares are being given to each one of them? Let's, I think, go further. It very clearly says that ABX issues requisite number of shares to discharge the claims of the equity shareholders of these companies. And I guess if you notice, we're already given the fair value of these shares, fair value of the business of AX and BX is given. So let me do one thing. Let me just note down what is the fair value of business. So we're given the fair value of the business is supposed to be 11,000. And this is supposed to be 14,000. So now we need to know how many shares will be issued to AX and the shareholders of BX. Now, since you've created a new company, ABX, it will end up issuing the shares at a face value of 10 rupees each. So in this particular case, we can consider the issue price is going to be equal to the face value itself, and that is 10. So in this particular case, since we are not given, it's a new company, it's not an existing company. So when it lands up issuing the shares will be issued at 10. So if the issue price is 10, we can get the number of shares to be issued. We can get the number of shares to be issued. So we can say 11,000 by 10, that comes to 1100. 14,000 by 10, that comes to 1400. So we can say the total number of shares is 25. So this is the total number of shares. So I think once we get this status, that what is the total number of shares, I think I am now ready to do the calculations. So ABX will issue 1100 shares to discharge the fair value of business of AX. ABX will issue 1400 shares to the shareholders of BX to discharge the consideration. So in totality, the company ABX will get a total of 2500 shares. So let's see what is the percentage stake they get. He is getting 1100 shares out of a total of 2500 shares. So let's see what is the percentage. He's going to get 1100 shares out of 2500 shares, and that works out at 44%. Can I say, which implies that he is going to get 56% shares in the company. And I think this point proves us that BX is the larger entity. BX is getting a control over the company ABX. Though the issuing company is ABX, he is the legal acquirer. But in this case, we can notice the control ultimately goes to BX, and therefore BX becomes the accounting acquirer. And as I said earlier, that this calculation is necessary because this 56% is what we need later in order to make the calculations of the purchase consideration. So in this particular case, we can say BX gets control. Thus, BX gets control. Thus, BX is the accounting acquirer. BX is the accounting acquirer, and therefore it is a case of reverse acquisition. And trust me, if you would have done those classes in detail as well, you would have noticed that, if a company, if a company new company is created and the consideration is paid in the form of equity shares only, it is undoubtedly a reverse acquisition. The new entity in such a situation never becomes, you can say, the acquirer. In this particular case, you can say that it'll always become a reverse acquisition. So we can say PX is the accounting acquirer. Okay, I think I've already written that. Okay, so my step number 2 is done. Now let's go to the step number 3, which is organizing the net assets of accounting acquiring. Now, in this case, again, we are not given any status as far as the tax rates is concerned. So if there is no information as far as tax rate is concerned, can I say in this particular case, again, no different tax implications would apply. Yes, step number 3 gets divided in two parts. One is in terms of industrial different tax implications, and the other one is in terms of the net asset list. Since the tax rate is nowhere given the question, therefore, we don't need to organize this particular data. Okay. So let's, I think, go further now on this. Let's create the net assets. We're going to take the net assets of which company? That is AX. So let's go back to the question and let's consider, first of all, the fair values of PPE and inventory. So maybe we can go with the order of the assets in the balance sheet. PPE is 9,500. So let's organize the data. So PPE is 9,500. Then there is investments 1050. So we've got investments 1050. Then there is inventory at a fair value, I think. That was to the tune of 1300. So inventories will be 1300. So we take the inventories, that's 1300. Next, we are given, there is trade receivable 1800. So there is trade receivables, that is 1800. Then I think there is cash and cash equivalents. I'm putting a CCE. The cash and cash equivalents is to the extent of 450. I think that's it on the asset side. Yes. And then we push on to the liability side. So we give the financial liabilities, borrowings are 3000. So let's take the borrowings. Let me put this in brackets. That is 3000. And the next item is the trades payable. That is 1000. So I guess that takes care of the data. We've taken the fair value of the assets wherever it is given. Otherwise, the book value has been taken as good as the fair value. So let's get the status. And this is to the tune of 10,100. So my step number 3B is also done. Now we are ready in terms of taking it to the next level. Now we can go and identify the purchase consideration, the most crucial and I would say the interesting step. So step number 4, that is the calculation of the purchase consideration. By the way, I think there is another small little question which is coming to my mind. So I think let me put that question also in advance at this stage. I guess even in this particular case, the purchase consideration is paid in the form of equity shares only. So am I going to perform a similar calculations which I did in the earlier case on reverse acquisition today? That instead of considering the fair value of what would have been issued, should we consider the fair value of what would have been acquired? What do you say? Because we know the purchase consideration is purely in the form of shares only. So if it is purely in the form of shares only, can I say in this case also, do you think similar calculations needs to be done? Am I supposed to consider the fair value of the shares acquired in this case as well? What do you say? Okay, I didn't get inputs on that, so let me answer that. Of course, yes. So let's do one thing now. Let's calculate the purchase consideration. So we can say we need to compute what AX would have issued to shareholders, would have issued to, sorry, what BX, so we need to calculate what BX would have issued to the shareholders of AX if he wanted to, maintain the same percentage, if he wanted to maintain the same percentage. And I think that percentage we had already calculated, I guess was 56%. As I said, this is what you organized in the step number 2 earlier. AX got a 44% stake and BX got a 56% stake. So we need to calculate that if BX wanted to maintain a 56% stake post business combination, how many shares he would have issued to AX. I think let's go back to the balance sheet and let's see that in this particular case, BX has got a total of 700 shares. So we can say let the number of shares issued by BX to AX, let's say, is equal to X. So we can say he's got 700 shares, plus he would issue another X number of shares, and the total number of shares, sorry, he's got 700 shares. The total number of shares post the business combination would be 700 plus X, in such a way that he wants to maintain a 56% stake. So similar calculations are being done that now once BX will land up issuing X number of shares, he will be left with 700 shares in the company. And the total share capital of the company is going to become 700 plus X. So we can say he gets 700 out of 700 plus X. So let's solve this. We get the value of X. So I think this is going to come to, wants to maintain a 56% stake. Is it coming to, I guess, 90, 50? If you can do the calculations to me. He's got a total of 700 shares plus X number of shares issued in such a way that you're able to maintain a 56% stake. So if you can solve this and let me know how many shares would he land up issuing in this case. Okay, I think I'll have to do the calculation. Anybody is working this out to me? So I guess if we solve this, I think it is coming to the extent of, yes, I think somebody's going to figure on this. So this works out at, right, it comes to 550. That's right. So X comes to a total of 550 shares. Wonderful. So once you get the status of this 550 shares, I think we get done. Now we can calculate the purchase consideration. So the purchase consideration is the fair value of the shares which would have been issued. So BX would have issued 550 shares, but we also need the fair value of BX. We also need the fair value of BX to do the calculations now. So what we need to do now, I need to organize the fair values of the company. And for this purpose, we can just make a small little working note, which is on the computation of fair value. We just need to calculate the computation of the fair value in this case. I think we already know the fair value of AX and BX business. So we know that the fair value of the business of AX was to the extent of it was to the extent of 11,000 and 14,000. So this was 11,000, this was 14,000. And if you divide this by number of shares, the number of shares in this company, I think, is 600, and the number of shares of this company is 700. So we will get the fair value per share. So this works out at 11,000 divided by 600, and that I think comes to 18.33. So this is the fair value 18.33, and this is, I think, 20. So what we've done, we've also organized the fair value of the share. Since we're given the fair value of the business, so we are able to convert this, divide it by the number of shares, and get the fair value per share. So let's come back on the agenda. So we can say in this particular case, 550 shares, and the fair value of the shares of BX is 20,000. So the purchase consideration works out at 11,000, and which is exactly equal to the fair value of the business of AX. And that's not a chance, because at the end of the day, the consideration has to be equal to the fair valuation of the business. Now, coming back to the agenda. So what we have computed in this particular case, we have considered, you can say, the fair value of the shares which would have been issued. But since the purchase consideration is purely in the form of equity shares, we should rather also see that what is the fair value, what would have been issued. Let's do one thing. We tell the examiner, since the purchase consideration is only in terms of equity shares, since the purchase consideration is only in the form of equity shares, we should consider, we need to consider fair value of what is acquired. We need to consider what is the fair value, what is acquired. So can I say BX, by issuing 550 shares, will get a control over the shares of AX. So which means he's going to get a control of the 600 shares of AX, and the shares of AX is 18.33, and that also works out at 11,000 itself. Every time we are calculating the purchase consideration based on the fair value of what is issued, or based on the fair value of what is acquired, we get the same results, because at the end, the exchange ratio is all based on, you can say, the fair values of the share. So that gives me the purchase consideration. Step number 4 is done. Now comes the step number 5. So in terms of step number 5, there is NCI. But again, in this particular question, there is no NCI. So I can just mention that, but we are not calculating any NCI. So there is no NCI. You just made mention that there is no NCI. Then you come to the step number 6, which is on the calculation of goodwill. And that is going to be a simple exercise comparing the PC and the net assets. So let's take the purchase consideration that we've already calculated, 11,000. Just to show the format, we add the NCI, and that is 0. And we reduce the net assets, what you've already computed in the step number 3. I think it was 10,100, if I rightly remember. So we should be able to get the goodwill as well. So we get a goodwill to the extent of 900. Wow. So now it's all about making the balance sheet of the company, which is not a big deal. So let me, I think, now ask you point blank. Well, if you want, I can make the balance sheet as well, but I think if you're comfortable, then I think I can skip that as well. But let me now ask a small little question to you. Can I say, in the step number 7, when you're going to make the consolidated balance sheet, tell me which company you'll take a fair value which company you'll take a book value. For company AX, are you going to consider the book value or the fair value? Remember, of course, AX is supposed to be the accounting acquiree in this case, and BX is supposed to be the accounting acquirer in this particular case. And that's why we said that AX we're going to consider the fair value, and BX we're going to consider the book value, and accordingly the balance sheet will be done. You want me to make a consolidated balance sheet as well, or you want me to skip that part? So as you wish. If you want, I'll do that. Skip. Okay, that's fine. Then I think the reverse acquisition is done. And let me make a statement now before we take a break. Can I say, in terms of common control, can I just add the two balance sheets and that's the answer? Is my thought correct? If I'm looking at the case of a common control, because this question has got two parts. One is the case of common control and one is the case of reverse acquisition. So if it is a common control, can I just simply add the two balance sheets as it is and you will get the balance sheet of the new company? That's right. So I think that is pretty manageable indeed. So that I think takes care of our questions on all the three categories. We're done on acquisition accounting, we're done on reverse acquisition, we're also done on the common control transactions as well. I think we've done a couple of questions on Ind AS 103. I think let's now take a break. And I think after the break, we should start with questions on consolidation. There is one more interesting question, but I think I'm not taking that at this stage. Not least we run out of time. So what I'm going to do, I'm going to start questions on Ind AS 110 after the break with you. And then if time permits in the next class, maybe we can come back to a little complicated questions later. Right, friends. So I think any questions on your mind? Otherwise, I think we'll just take a break. So let's see you in another 10, 12 minutes. I'll be back. So please enjoy a break. So welcome back, friends. I hope you had a relaxation of mind. So we've done our inputs on Index 103, and now we're going to make a switchover in terms of Index 110. As I already told you, consolidation, of course, is an exercise which contains a couple of plethora of standards. So Index 110 deals with consolidation of a subsidiary. Then, sorry, Index 28 deals with the concept of associate accounting, and 111 deals with the concept of joint arrangements. So what I'm going to do right now, I'm going to start with not a very basic question, of course. We're going to take an examination question and do a question on 110 consolidation. Now, if you've seen the detailed lectures, you would notice that again, we're going to follow a simple 7-step model in terms of solving a question which is related to the consolidation. I guess maybe we can work upon the mind map later. But I think as I progress, I'll just keep telling you the key considerations which you need to keep in mind when you're applying this 7-step model. But just to quickly give you the inputs, the step number 1 is identifying the acquisition date and the percentage. The step number 2 is on the analysis of equity and getting the status of the net assets. The step number 3 is in terms of calculating the purchase consideration. The step number 4 is calculating the NCI. The step number 5 is calculating the goodwill, slightly change in numbers. The step number 6 is calculating the consolidated balance sheet, other equity. And then finally, step number 7 is going to make a consolidated balance sheet. So we're going to simply apply a 7-step model irrespective of the intensity of the question. Every time we're doing a question on 110, we're going to apply the 7-step model. Let's share the question with you and let's begin the journey. So we're looking at question number 7, question 11. And I think this is one of the good questions which has come in the exams. It is June 2019. It came for 15 marks in the exam. So let me, start the inputs. Let me read the inputs to you. So it's a basic question, warm-up exercise, you can say, is what we're doing. Then after this, maybe we can make some mind maps, before we go to a complicated question. The summarized balance sheet of PN as well as SR is given. That is the balance sheet of both the parent and the subsidiary defined. Then it says PN acquired 70% shares of 100 each of SR on 1st October 17. The retained earnings of SR showed a credit balance 93,600 on 1st April 17, out of which a dividend of 12% is paid on 15th December 17. PN has credited the dividend received to its retained earnings. Now, this is an interesting point where sometimes people tend to get confused. So that was the reason of selecting this particular question. Now he says that as far as the dividend is concerned, the parent received the dividend and it was credited to RE. So what he did was correct. But then we also need to remember that from a group point of view, it's not an income. Though he is credited that in the retained earnings, but from the group point of view, it does not represent an income. There will be need to eliminate that from the retained earnings. The fair value of the plant and machinery is given. The depreciation rates are given. And the further increases in comparison to the fair value as per the respective indices. So we're given the land and building inventories as well as the payables where the fair value difference is defined. The inventory is still unsold on the balance sheet date and the trade payables are not yet settled. The other reserves on March 18 is the same on 1st April 17. The business activities of both the company are not seasonal in nature, and therefore you can assume that profits earned evenly throughout the year. I think that goes without saying. Even if it is silent, we always assume that profits are earned evenly throughout the year. So we require to make a consolidated balance sheet on 31st March 18. So I think let's begin the journey. So what I'm going to do in this particular case, let's, organize the data. So I'm going to the question number 11 in this case. So we'll organize the 7-step model in this particular case. So let me just organize the input starting with the step number 1. So in terms of step number one, as I said, we'll organize the date of acquisition and the percentage. So let's get the date of acquisition and the percentage in this particular case. Now, when you organize the date of acquisition and the percentage, we just simply look at the data in the question and get the percentage and the date. That's it. Nothing we need to see in detail. So if I go back on the inputs, so I am very clearly given in the very first point itself that PN acquired 70% shares in SR and on 1st October 17. So we given the percentage is 70%. So let's put the date of acquisition and the percentage as well. So in terms of the date of acquisition, so we given it is supposed to be 1st October 17. So that's 1st October 2017. And I think if you look at the percentage, it's very clearly given, it is 70%. So there is no challenge in terms of the step number one. Trust me, it's going to be as simple as it sounds, that you just need to look at the data in the question directly, get the percentage and the rate of acquisition. Now comes the step number two. Now, my focus is when you're looking in terms of the step number two, you should first of all identify that are we required to make a consolidated balance sheet on the date of acquisition, or are we required to make a consolidated balance sheet at a later date? Invariably, in most of the questions, we are required to make a consolidated balance sheet at a later date. In which particular case, what you need to do, you need to split your step number two in terms of two parts. In terms of step number 2A, we will do the analysis of profit. That is analysis of equity of the subsidiary company, segregating what is pre and what is post acquisition. And we will also be able to calculate the net assets as well. So in terms of step number 2A, we will work out the analysis of profit, or we can say the analysis of other equity. So we will work out the analysis of other equity in this particular case. Now, I would suggest when you're looking at the analysis of other equity, I would say there are at least three focus points which you should concentrate on. Number one, you look at the balance sheet of the subsidiary company and focus on the other equity of the subsidiary. That's a very basic level because that's what you need to do in the analysis. The second focus point is go to the additional information and locate any fair value adjustments. We'll have to take care of any fair value changes in this particular case. And then I would say the third focus point is you need to consider any stock reserve. But remember, that is supposed to be upstream in nature. So when you're working out the analysis in step number 2A, you should have three focus points at the back of the mind. One is in terms of the other equity given in the balance sheet. Second is in terms of any fair value adjustments. And third is we need to consider any stock reserve, which might be upstream in nature. So what we're going to do first, we're just going to organize the inputs. We're going to consider the particulars, and we're going to consider pre-acquisition, and we're going to consider post-acquisition. We'll define the pre-acquisition in terms of pre, the date of acquisition, that is 1st October 2017. And the post-acquisition would be anything which is earned from the date of acquisition, that is October 17 to. Now let's see what is the balance sheet date. So I think that's March 18. So we're going to consider till 31st March 18. Now, another interesting thing which you need to watch out at this particular case. We can clearly see that the year 1718 is supposed to be partly pre and partly post in nature. We can see that it is partly pre and it is partly post in nature. Because 6 months is pre-acquisition and 6 months is post-acquisition. So we need to split this between the two elements. So I think that will take care when we come to the analysis. Let's first come to the sorry. Let's come to the balance sheet of the subsidiary. So let me just come back on the balance sheet of the subsidiary to look at. Now, if you look at the balance sheet of the subsidiary, we can clearly see that there are two elements in the other equity in the balance sheet of the company. One is the other reserves and one is the retained earnings. So when you split that other reserves and the retained earnings in terms of pre and post, and I think if you go down, you're given something in the additional information in point number 2. It says retained earnings. It says showed a credit balance on 1st April that is 93,600, out of which we paid a dividend on 15 December. So let's work out the retained earnings breakup. So we know that as far as the retained earnings are concerned, it very clearly says that the retained earning was 93,600 on beginning of the year. Mind you, it's not at the acquisition date. It is at the beginning of the year. So it says out of this, we paid a dividend as well. This profit is not still available because when you paid a dividend out of this, what is still available is after the reduction of dividends. So if you look at the dividends, it says it is paid at the rate of 12% on the share capital, which is 624. So we can reduce that on 624 share capital, we paid a 12% dividend as well. So let's see what is the balance left over. 624 into 12% dividend, 93,600. I think it works out at 18,720. That works out at 18,720. Now, there is an interesting catch which we need to be careful on later. We'll talk of that later. But one thing, now if you look at the status of the RE in the balance sheet of the company, it is appearing at 255,800. So we can say out of 255,800, so we can say 18,720 is the balance at the beginning of the year. Mind you, this is not to be taken as post-acquisition in nature, mind you. When you say 18,720 is the balance at the beginning of the year, which means this increase is the profit earned during the year. And if it is an increase during the year, we need to divide this in the time ratio, which is 6 months is to 6 months. So we can divide this increase, that is 255,800 minus this. I think it works out at 1,18,540. And this also comes at 1,18,540. So this is one thing we need to be careful on, that when you're calculating the status of the pre and the post acquisition, you need to work out carefully that if you're given the balance on acquisition date, the entire increase becomes post. But if you're given the balance at the beginning of the year, then the increase will be divided in the time ratio. So I think my first focus point is taken care. Now we need to go to the second focus point. And the second focus point is to look into the additional information for any fair value adjustments. So we'll go to the additional information and see if there are any fair value adjustments which needs to be incorporated. Let's go back on the additional information. I guess we're given the information in point number 4 as well as in terms of point 5, which is indicating the fair value adjustments in the question. The fair value of the machinery on 1st October is 624, but we need to compare this with the book value. So in this particular case, in point 4, I am not given the book value, but I'm given the depreciation rate is at the rate of 10%. Now, which means if your depreciation rate is supposed to be 10%, the figure which is there in the balance sheet represents 90%. Because if you take a 10% depreciation rate, then the book value of the asset is going to be remaining 90%. So what we can do in this particular case, we're looking at the plant and machinery. We're going to make some calculations. 421,200. So let's make a little working note at this stage. That is on the plant and machinery. So we know that what is the value on the book value on 31st March 2018. And the book value on 31st March 18, that is clearly given, it's 421,200. This is 421,200. So this represents 90%. because there is a 10% depreciation. So if you take 421,200 divided by 90%, you can say gross it up, it becomes 4,68,000. So this is, we can say, the book value on 1st April, that is at the beginning of the year, 1st April 2017. But the idea is not to get the book value at the beginning, but to get the book value on the date of acquisition. So we can take care of 6 months depreciation. So we need the book value. It says on 1st October, that is middle of the year 2017. So we can say out of that 4,68,000, we can take a depreciation which is 10% for 6 months. So if we take a 10% depreciation 6 months, it works out at 23,400. So you can see that we've gone back and then we've come forward, and we consider 468 minus 23,400, it comes to 4,44,600 is the book value, which is on the date of acquisition. Wonderful. Now, once you organize the data, now I am in a position to compare the book value and the fair value. So let's go to the plant and machinery. So if we come back on the additional information in terms of point number 4, the fair value of the plant is 624. So we can say the plant is revalued at 6,24,000 and the book value is 4,44,600. So we should be able to get what is the fair value increase in this case. And that is always a part of the pre-acquisition column. Because whatever fair value adjustments we make, there is always a part of the pre-acquisition column. So we take the difference 624 versus this 179,400, that is the fair value increase take. Anything else to be considered as a part of the fair value adjustment? Is there anything else we need to consider as well? Because whenever you consider a fair value adjustments, then there is another calculation also which is required, and that is additional depreciation. So we also need to consider the additional depreciation, which is going to be taken on, you can say, prospective basis. So we're going to consider the depreciation on a prospective basis. So we can take the depreciation on this 179,400. On this 179,400, we can take a 10% depreciation for a period of 6 months. So that will give us the additional depreciation. Take this in the brackets, it's an expense. That works out at 8,970. So that was the second focus point. So when you are considering the analysis of equity in terms of step number 2A, I would say the focus point in this particular case is, number 1, you need to see the other equity in the balance sheet of the subsidiary. Done. And I think we also dismissed the reserves and all. I think in the balance sheet there was, other than retained earnings, we were also given other reserve. And for other reserves, we were very clearly given. It says in point number 7 that other reserves on 17 beginning and 18 ending is same. So other reserves is completely free. Let me also put that before we forget. So let's take the other reserves as well. And that is supposed to be 3,12,000. Right. So this is done. So focus point 1 is done. The balance sheet equity. The focus point 2 is done. Fair value adjustments. But there are more fair value adjustments given. That was point 4. Now there is point 5 with more fair value adjustments also defined. It says the following are the increases in comparison to the fair value as per the respective Ind AS with the book value on 1st October 17. So this is the fair value increases given. So let's take one by one. So we've got land and building. So we consider the land and building, and that is 3,12,000. Next, we are given inventories. And on a very safe side, he's also very clearly said that all these inventories are unsold at the end of the year. If it is not unsold, but it is being sold off, we'll see those nitty-gritties later, next session. So 46,800 is the increase in the inventory. So that works out at 46,800. And then there is also, this is increase in the asset value. Trades payable has also gone up by 31,200. Now remember, increase in trades payable is a loss. So take that in brackets. I think all the fair value adjustments are taken care. Now, once we are done with this input, it's time to go back and see if there is any stock reserve transactions. I don't think so that we've given any stock reserve transactions in this particular case. So this is done. So I think we can now comfortably take the sum total of all this. Let me just shift this out here so it doesn't disturb my total figures as well. So let me take the sum total out here. So we get the total out here. This is going to be the pre-acquisition in nature. So this gives me the pre-acquisition 956,260. Let's also take the post-acquisition. Let me shift this as well. This will also come in between the total, I guess. So let's put it a little aside. So we get the sum total of this as well. So the pre and the post acquisition is done. Wow. So the analysis of the other equity is done with the three focus points, as I said. And I said the focus point is in terms of analysis. One is the other equity in the balance sheet of the company. The second is you start looking into the calculations of the fair value adjustments. And the third is you start looking at upstream stock reserve. Now comes a very interesting calculation which we need to be careful on. And that is, when you're doing the step number 2B, we need the net assets on the date of acquisition. Now, this is crucial. Now, this is very crucial indeed. You know, if you remember, when I was doing the analysis of equity in the calculation of the retained earnings, I think if I take you back, you can see in the calculations of the retained earnings, when we calculated that 18,720, we took the balance that was 93,600 minus the dividends. But these dividends were paid on 12th December. So when you're calculating the net assets on the date of acquisition, we need the figure which is without reducing dividend. So I would suggest if there is a dividend which is given in the question, it's a good exercise that you organize two different net assets. Mind it carefully. Let me put this once again. I would say in a situation where you are given the status, that there is a dividends paid, it is a good idea that in terms of the step number 2B, you organize two net assets. One is the net assets, which is without taking the dividends into account. And one is the net assets, which is after reducing dividend. Because when you're going to calculate the goodwill, you need the status of the net assets on the acquisition date itself. So in this particular case, it'll be a good idea to organize two net assets. So what I'm going to do in this stage, I'm going to calculate the net assets without reducing dividend. Without reducing dividend, because dividend was not paid on that date. And we'll also calculate the net assets after reducing dividend. So it'll be a good exercise to do that because you'll be able to keep a track of the inputs. Trust me, that's a good way of keeping a track whenever there is dividends in the question. Get the figure of two net assets. So if I'm calculating the net assets, we need the sum total of the equity share capital, and we need to add the pre-acquisition profits. We need to add the pre-acquisition profits, which you've taken in the analysis. Let's go back on the balance sheet and let's see what is the figure of share capital. The share capital of the subsidiary is given to me 6,24,000. So this is 624. And if you look at the pre-acquisition profit, now remember, this figure, which is 956,260, this figure is after reducing the dividend. This is after reducing the dividend. Oh. Okay, I think let me put it out here. So this is 956,260. What I'm going to do, I'll add back the dividends in this case. So what was the dividends? We paid on 624 12%. There is 74,880. So I just add up 74,880. That is the dividend. So we get the profits without reducing dividend. I've just added back the dividends in this particular case. So once you add this up, this is coming to 10,31,140. So this is going to be 10,31,140. Let me just put this to a journal number. Okay. Then similarly, this is going to be 624. The share capital, of course, remains the same. And this is going to be 956, 260. So we can, I think, comfortably take the total. This is the net assets after dividend. So this is the net assets after the dividend. And let's also get the net assets before the dividends. So once you're able to organize this particular data, trust me, now my job is going to be simple. One of the ideas of taking this question was also the presence of dividend, because the presence of dividend, makes the things a little complicated. So I reiterate the inputs back. Once there is a dividend in the question, it will be a good exercise that when you come to the step number 2B, you organize the net assets before and after the dividends. That would be a very good exercise to do. Okay, now we go on to the step number 3. The step number 3 is now on the purchase consideration. And that's technically nothing, but you can say it is supposed to be the investment which appears in the balance sheet of the parent. Because when you're looking at the purchase consideration, the focus is in terms of investments in the balance sheet. So I think we can see the investments in SR, and that is appearing at 1248. So we can see the investment that is appearing to the extent of 12,48,000. Okay, so I think this is done. Now we are ready to go to the next step, and that is the step number 4. Now, in terms of the step number 4, we need to calculate the NCI on the date of acquisition. So now we need to be a little careful, because we are trying to organize the net NCI on the date of acquisition, rather not on the date of acquisition, I would say. Technically speaking, it is a net assets on consolidated balance sheet date, because we are trying to calculate the NCI as on the balance sheet date. But the next step number 5 is going to be crucial, because step number 4 and 5 in terms of dividend involves a very important input. That when you consider the net assets, are you going to consider the net assets after, or are you going to consider the net assets before dividend? So that is what we're going to work upon this particular case. First, let's take the NCI on the date of acquisition. So we need to see that the NCI is at a fair value, of the NCI is at a persona. I don't think so. I am anywhere given any information about the NCI in the additional information. So it should be at persona. So I think now the question rises, when you take the NCI, now let me ask that question to you. When you're going to take the NCI, are you going to consider the figure after dividend or before dividend? Let me ask you that. I want to calculate the NCI on the balance sheet date. And for this only, I need the NCI on the date of acquisition. So any inputs, what are you going to consider in this case? Are you going to consider the net assets on after dividends or before dividends? Any inputs on that? Okay, I think I'll have to answer that question. We are going to consider the net assets after dividend, because you are calculating the NCI on the balance sheet date and the dividends has already been paid by that time. So in this particular case, when you consider the calculations now, we're going to consider the net assets after the dividend. This is 1580. This is 1580, 260. And I think there is a 30% stake of the NCI. because there was a 70% stake belonging to the parent, I guess. Yes. So we can take a 30%. So remember, when you calculate the NCI, you need to consider the net asset post the dividend. 1580 to 60 into 30%, that's 474. And this is 078. And now to this, we need to add the share in post acquisition. So in terms of post acquisition, you go back to the analysis. So if I look at the analysis, the post acquisition profit is 109,570. So let's take the total 109,470, was it? 109,570. So out of this post acquisition profit, 109,570, 30% belongs to the NCI. Let's take that. So this is going to be 109,570 into 30%. That works out at 32,871. Now, in terms of NCI, the other informations which you would require would be in terms of the impairment, if any. Now, I'm not given any status of goodwill impairment, but if the NCI would have been a fair value and there would have been a goodwill impairment, we would have taken that as well. But right now, there is no goodwill impairment. So this gives me the NCI calculations as well. Wow. So this is the NCI done. So you get the focus point. For NCI, we need the net assets after dividend. We need the net assets after reducing the dividends. Now, coming back to the agenda again, this is going to bother us even in terms of step 5. When you go to calculate the goodwill, the same inputs will now come to the mind. Step number 5. That is on the goodwill calculation. So can I say, in terms of the goodwill calculations also, we would need the net assets on the date of acquisition. I think let me take the liberty of putting that question once again to you. You would consider the net assets in this particular case, which is supposed to be before or after reducing dividends. So in the meantime, let me just organize the data. PC add NCI on date of acquisition less net assets, that is on date of acquisition. So now the question is, when you're going to calculate the goodwill, are you going to consider the net assets before or after reducing the dividends? I think let me answer that question as well. We are going to consider the net assets without reducing dividend, because the status as on the date of acquisition is the dividends were not paid. The dividends were paid on 12th December. So in this case, we're going to pick up the figure which is supposed to be, without reducing dividend, 1655,140. So let me put this out here, 1655,180. So this gives me the status of the net assets, 1655,140. So this gives me the status of the net assets, which is without reduction of dividends. Now, there is one more important caution which we need to be careful on. So I think let me also pinpoint that part as well. This has got stuck up, just a second. So another important input at this particular stage is when you're considering this calculation, the NCI which you need to consider is not to be taken from the previous step. Please, by mistake, do not take the NCI from the previous step, because that NCI is based on the figure after dividend. So what you need to do, you need to consider 1655,140 into 30%. We need to take the NCI which is based on the figure which is without reducing dividends. So this is going to be 1655,140 into 30%. That works out at 496,542. So I think your dividend, the presence of dividend, can increase our calculations like anything. So I'll just make that quick mind map later as well, but let me just reiterate the inputs once again. The moment you are given in the question the status of the dividend. When you do the step number 2A, you will definitely land up reducing the dividends. But what you need to take care is that once you organize the data, that is the net assets, you should get two net assets. One is without reducing dividends and one is after reducing dividends. When you take the calculation of the NCI, the focus is the balance sheet date. So you need to take the net assets, which is after the payment of dividends. But when you are calculating the goodwill, the focus is the acquisition date, in which case you need to take the net assets, without reducing any dividends. So that is what the focus point. So let me put it out here. We need the net assets without reducing dividend. So crucial points which we need to consider in mind. So let me now organize the inputs. We can now get the goodwill calculations as well. So let me just go back to the purchase consideration. It was 12,48,000 is the PC. This is 1248. So let me now get the figures in this case. So we take the sum total of this and we reduce this. So this gives me the goodwill, which is 89,402. That becomes the goodwill. And of course, we would have made the reduction in terms of impairment, if any. Had there been any impairment, we would have made a reduction as well. But in this particular case, there is no impairment, so we've not taken any inputs out here. Okay, wonderful indeed. Now, moving further, once we get the goodwill, now we need to organize the step number 6, which is making the consolidated balance sheet other equity. So once you organize this, we get the net assets, the consolidated balance sheet, other equity is what we need to organize. Let me now also give you the crucial points which you need to keep in mind when you're calculating the consolidated balance sheet, other equity. Every step has got some crucial points which I'm going to pen down after the end of this question, so that your mind is clearly clear that, okay, these main steps are small little mind map in terms of what we need to be careful of. So in step number 6, you need to take the parent company's own equity. That's one. Then you need to consider the post-acquisition share in profits, focus 1. You need to consider the reduction of stock reserve that is downstream in nature, focus 2. And you also need to consider the element of goodwill impairment, if any. Right now, we don't have any goodwill impairment. Right now, we don't have any stock reserve. So I think the only inputs to be taken is the post-acquisition share. So let's first go back to the balance sheet of the parent. So in the balance sheet of the parent, we've got other reserves 936. So we make separate columns. Let's take the other reserves. We'll take a separate column on this. And we've got the retained earnings. So let me just pick up the information. So I think we can first take holding company's own profits. So let's take the holding company's own other reserves. I think the other reserves is 9,36. So that works out at 936. We can get the retained earnings as well. That's 178,400. And I think the only input to be taken is the post-acquisition. So add the share in post-acquisition. So for that, we go back to the analysis again. And I think the analysis gives you the post-acquisition is 109,570. So out of that 109,570, 70% belongs to the parent company. So let's add this out. So 109,570 into 70% belongs to the parent, and that works out at 76,699. So with this, we can get the status of the total, and this works out to the extent of 255. So this is the only inputs to be seen. There's nothing further. So otherwise, the focus points are 3, but in this particular case, since we are not given any further information, there is no stock reserve to be taken, 1, and there is no goodwill impairment to be taken. So we can just also add these two elements as well, because in the balance sheet, this is going to appear as other equity as well. Okay, wow. So I think this takes care of the inputs in terms of all the 6 steps. Now, you want me to make the consolidated balance sheet as well, or you want me to quickly now give you certain crucial steps, the crucial key points to be kept in mind, and make a small little mind map that when you're working on the different steps, what points do we consider? Or you want me to make a consolidated balance sheet? The choice is yours. So what do you want me to do in this case? Mind map, or you want me to make the consolidation? Mind map. Okay. So I think let's do the needful in this case. So balance sheet would be manageable, I guess. So now we can just make a mind map in this case. So as I create now a little mind map in this particular case, we can say, I think step one is got nothing specific and nothing crucial indeed. I think my focus is in terms of step number 2A. That is analysis. That is analysis of other equity. Now, what is the crucial points to be taken care in terms of step number 2A? Let me tell you point blank. And it's going to be easy remembrance, because more or less in all these points, we're going to focus in terms of 3 focus points mainly. So I will say the first focus point is that we look at the other equity. We look at the other equity in subsidiary company balance sheet. Because the focus is to do the analysis of the subsidiaries company other equity, so that becomes the very first focus. That's the base. The second focus is we need to consider the fair value adjustments. The second focus is to get the fair value adjustments, and in the pre-acquisition, you're going to consider the fair value changes. And I would say in the post-acquisition, we're going to consider the additional depreciation. So we should also know that in terms of the fair value adjustments, what we need to do. So we need to consider the pre-acquisition fair value changes, additional depreciation of the post. The focus point number 3 is that we need to consider the stock reserve. And this stock reserve is going to be upstream in nature. Downstream is taken care later in step 6. And this is going to be reduced. This is going to be reduced from post-acquisition unless mentioned otherwise. That means when you are going to consider the stock reserve, unless mentioned otherwise, we're going to reduce this from the post-acquisition column. I think these are the 3 crucial points. Every time you're doing your step number 2A, you must keep these 3 main points into account. That there is, first of all, what we need to see is the subsidiaries other equity. Additional information, watch out for 2 things, stock reserves and the fair value adjustments. Now, let's come to the step number 2B, the focus points. That is getting the net assets. That is getting the net assets on the date of acquisition. Now, in this particular case, I think let me also give you the focus points out here. If you are given the dividends, you should organize 2 net assets for sure. So we can say if we are given. So if we are given dividends in the question, then I would say we need to organize 2 net assets. We need to organize 2 net assets. One is, you can say, the net assets after deducting dividend. And one is we need to get the net assets, which is before deducting dividends. So we need to organize 2 net assets. One is after deducting dividends, and one is the net assets which is without deducting dividend. And where do you need to use this information? I think let's also pen this down. When you take the net assets before deducting dividend, we can say relevant for goodwill. And when you say it is after deducting the dividend, it is relevant for, it is going to be relevant for NCI, because NCI we need on the balance sheet date. So it's a good exercise that you organize in step number 2B, the two things. Step number 3 is PC. PC will involve all those inputs what you've done even in terms of Index 103. So there's nothing more than what is there. Then step number 4, which is on the calculation of the NCI, though I think I've already given you the point, but there are again two focus points. One is we need the NCI either at PASNA or at a fair value. So you need to be careful, because this will decide the status whether goodwill is full or the goodwill is partial. So in this particular case, when you're calculating the NCI, this will decide that goodwill, this will decide whether goodwill is full or partial, because accordingly you'll have to make a reduction. Accordingly, you'll have to make a reduction of the impairment as well. The second focus point is, what you need to consider in this particular case is, you can say impairment reduction. We can say it is going to be impairment reduction. So in this case, we need to consider the second focus point is the impairment reduction. If NCI is at fair value, otherwise there is no reduction. And third is we need the net assets. We need the net assets after reducing dividends. After reducing the dividends. So I think these are going to be the three focus points in terms of calculating the NCI, PASNA or the fair value, impairment reduction if it is fair value, and you need to take the dividends things. Three focus points once again. Then we come to the step number 5, which is on the goodwill calculations. And I think in terms of the goodwill calculations, you've got two focus points at least. One is you need to consider the NCI based on net assets. You need to calculate the NCI based on net assets on date of acquisition, which is before reducing dividends. Number 2, we need the impairment reduction always. Doesn't make a difference whether the NCI is a fair value PASNA, impairment reduction is going to be done always. So NCI to be taken, and of course we also need to take the net assets, that is before reducing dividends. If you keep these crucial points in mind, trust me, life is going to be quite simple indeed. And you will notice that I've crucially given you three focus points all throughout. And then we also look at the step number 6. When you take the consolidated balance sheet, other equity, let's see what is going to be the focus point in terms of this. And you already know that there are a total of 3 focus points in this case as well. Even in terms of other equity, we've got 3 focus points. The first focus point is, of course, what do? You take the base as holding company's own profits. The holding company's own profit is taken as a base. Then there are 3 focus points. We need to consider the share in post-acquisition profits. And when you get the share in post-acquisition profits, you will get this from step number 2A. From the analysis, you will get the share in the post-acquisition profit. Then focus point number 2, you need to consider the stock reserve. And this stock reserve is supposed to be downstream in nature. This is going to be downstream, and you're going to get this from additional information. You're going to get this from the additional information as well. And finally, the third focus point is the goodwill impairment, if any. the goodwill impairment, if any, that becomes the next focus point. So, moral of the story, I think I've given you the inputs in terms of all the places, three focus points. If I just quickly, take a recap in terms of my three focus points, you can see in the mind map now very clear. In the step number 2A, you've got three focus points. You need to consider balance sheet of the subsidiary, fair value adjustments in the additional information, stock reserve that is upstream in nature. In terms of NCI, three focus points. NCI based on personal or fair value, take a call. Impairment if NCI is a fair value, and you need to take the net assets after reduction of dividends. The goodwill, again, three focus points. NCI based on the net assets, impairment reduction is done, and the net assets before dividends. And of course, in the consolidated balance sheet, other equity, you need to consider again three focus points: the share in the post acquisition, then you need to consider the stock reserve and the goodwill impairment value. So today what we've just done a very simple and a straightforward question, which was containing some basic level of adjustments, and we've seen the key focus points as well. And let me also tell you one more important input as well. Sometimes in the question, there might be some information which is supposed to be, you can say, omission. If you're given any kind of omissions in the question, you need to basically make an extract balance sheet as well. I remember there was a question in the exams where there was, an omission, and in that particular case, an extract balance sheet was required to be made as well. So we'll, I think, catch up with that kind of questions in the next class. So in the next session, we're going to do some more complicated questions with you on Ind AS 110. I hope, friends, this gives you a good insight of the inputs, at least on Ind AS 113 and 110 as well. Okay, so I think that seems to be all good for the day. I think everybody's perhaps left for the office as well. So I think that's all for the day, friends, from my side.
Thank
Good
you,
morning,
sir.
ma'am.
Thank you, sir. And students, just please take care in case you have any other, because topics have well and schedule has been uploaded on the website and it's well in advance or communicated to you all. So in case you feel that you want a good benefit of these classes, just come well prepared, just revise the chapter before this so that important questions, whatever is covered during the session, you are able to appreciate that. And in case you need any other questions or more revisionary classes for more practice of questions, you can let us know. Okay. Thank you, sir.
Thank you, ma'am.
Thank you. Bye.
Right, friends. So I think that comes to an end. Thank you very much. Bye and take care. Haji, thank you.